Hi, welcome to the quick insight for today, and we will be talking about the latest news with regard to the streamlined offshore procedures. I know that many of you tax professionals are familiar with these procedures and have been using them and thinking they are actually the cure-all for your clients, but we've had some recent developments that I'd like to talk to you about so people will be realizing that the IRS is now heavily policing streamlined applications, and in fact, they have been looking back at older applications into the streamlined program, whether it be the streamlined foreign offshore or the streamlined domestic offshore procedure. I know of a tax professional that I'm in touch with who has indicated to me that one of his clients who went through the streamlined foreign offshore procedure in 2014 was audited, and the Department of Justice determined that he was not non-willful. So that's becoming a big mess. That individual has now been charged, and we will see how that develops. But the important point to remember now is that streamlined is not the panacea that people believed it once was. The linchpin of going into a streamlined procedure means that your client has to be ready to show his tax non-compliance was what we call non-willful. So what does that mean in terms of a taxpayer? In the old days, professionals believed being non-willful meant that the person did not intentionally violate a known legal duty. So, for example, if your client didn't know about FBAR, you felt you may have had an argument that he was non-willful. That is not really working these days. The statement of non-willfulness has to be very, very detailed. And what the courts have essentially told the IRS and Department of Justice in the latest cases is that if you have something called willful blindness or reckless disregard of your duties to do something, then that will be meaning you are not non-willful. Reckless disregard or willful blindness means that you are kind of turning your back on information that you should be finding out more about. So you should be looking and reading the IRS website. They have tons on FBARs and how to come into compliance and what you mean by willfulness and non-willfulness. We have two recent cases that I'd like to talk to you about, and this will kind of demonstrate where the IRS is going with the streamlined procedure. One of our cases involves a very elderly couple that had a dual citizenship, one from birth and the other one naturalizing to become U.S. citizens. So this was a couple that was quite elderly, in their late 80s, and the husband was actually in his 90s. So what had happened was they had accounts in their country of original citizenship, New Zealand and Canada, and they had them for many, many years before they ever naturalized as U.S. citizens. They kept those accounts active, which is completely understandable because these were countries where they were citizens and they were probably going there from time to time. In any event, what happened was the husband passed away, and at that time his wife discovered he had certain accounts that she, in his separate name in the other country, that she didn't know about. So she went to attorneys to help her in settling the estate and explained to them that her husband had certain accounts in New Zealand that she did not know about. And in all the course of the discussion, the attorneys learned that this woman, Mrs. Jones, also had accounts in Canada, and these had not been properly reported. She explained that they believed so long as the funds in the accounts were being taxed in Canada and New Zealand, respectively, that they didn't owe any U.S. duties regarding these accounts. And they never, ever touched the funds in the accounts. They never used them, brought them back to the U.S. or anything of that nature. So they felt the funds were completely remaining offshore, and they were paying tax in Canada and New Zealand, and therefore they had no U.S. liabilities. The couple eventually tried to go into the streamlined domestic offshore procedure because they were living in the US, so they needed to use the streamlined domestic procedure. When they attempted to go in, the IRS agent did not accept their statement of fact, trying to assert that they were non-willful with their tax non-compliance. The IRS agent took a very hard line and said, no, we believe that you were willful. It was basically on an issue of reckless disregard is what the IRS agent was seeming to think was going on. So they recklessly disregarded learning about FBAR and doing what they should have done. The agent came up with a huge penalty amount. I mean, it was over $1 million. And in the meantime now, Mrs. Jones, who was acting as executor of the estate of her husband, she passed away, and now the executor of her estate was trying to fix this mess. And it's a total mess now that both of the taxpayers have passed on, because I don't know that you can ever go into a jury and try and assess whether they were willful or not, because they're gone. They can't testify as to what was happening for all those years that they had the accounts. I felt that this was a very sad case, but I believe this case, which is Stephanie Flint and David Jones as executors of the estate of Margaret Jones. So I believe that this case is a federal court of claims case, and it was just decided in August of 2022. I believe that this is giving us a strong precedent for what the IRS is thinking with regard to Streamline now as they're policing these cases. It provides, I think, a valuable lesson. The Jones couple were, in my view, benign actors. At their age and the fact that the accounts were in countries where they had their citizenship from birth, along with the fact that Mrs. Jones tried to, in fact, fix the tax non-compliance. They had used a CPA who was not familiar at all with FBARs or overseas accounts. He never explained anything because he didn't know about the rules. So their CPA was a little bit ill-equipped to handle their kind of matter. This all painted a picture for me that these were not bad actors, that these people really did not exhibit, in my mind, willfulness in their actions. But of course, the IRS has disagreed, and we're going to see what happens, because it doesn't look good for this couple, especially, as I said, now that they have passed away and the matter has gone into the estate. We do have cases where we clearly have bad actors. And a few of those cases, Mr. Rahman Azizur is one of them. The Department of Justice released its news release about what he was doing. He clearly was a bad actor, not being truthful with his foreign accounts, had a lot of businesses going on, and was trying to hide things with various shell corporations. We also have a former CPA who was doing a similar thing and tried to go through the streamlined procedure. Both of these actors got caught out because we see the Department of Justice and the IRS are working closely together and policing these streamlined cases that are going in. As I said, my colleague has one from a case that went in 2014, and that client was just recently charged with various, unfortunately, tax crimes. So let's see what's going to happen as this develops. But I believe people have to be far more careful now using the streamlined procedure. As you are aware, the statement of non-willfulness, the statement of fact about non-willful tax non-compliance, is the linchpin of getting through your client, getting that person successfully through the streamlined submission. What we are suggesting people consider now, tax professionals should consider, when their clients are telling them the facts, and you are helping them write the statement and making them read it and revise it and review it, it might not be a bad idea to have them sign an affidavit that everything they have told you in preparation for this statement of fact, have them sign an affidavit that those facts are true. So at least you have something in your record that is clearly giving you a powerful tool to say you have done your due diligence and your client has signed an affidavit that these facts are true. What you should also be doing when the client tells you certain things, what can you possibly follow up on to just fact check and see if it's accurate? So if the client says to you, well, we never touched the funds in the account, you've got to, of course, be looking at the bank statements. You're going to have to prepare late FBARs. As part of that, look through the statements. See, has the person told you the truth, that they've never touched the funds? There are certain things you can do. I believe that professionals nowadays really need to be far more proactive, especially if they're putting a client through the streamlined procedure. I know that a number of professionals are very worried. For example, the enrolled agent or the CPA, they don't like dealing with that statement of fact. They prefer someone that has a legal background to assist the client in preparing that. They don't want to be responsible. They don't want to be left holding the bag, so to speak. So it's become an area that's being more and more difficult to navigate these days. Another case which does not involve a streamlined procedure, but is very telling, is the case of Marika Kathalos. Marika Kathalos' case has been going on for over 4 years now. And I can just imagine how much these poor people have spent in legal fees and how much sleep they have lost over this entire shenanigans with the IRS. The bottom line is that they had certain accounts, foreign accounts at UBS. Marika was the taxpayer. She moved to Greece in the 1990s. Her husband was a Greek national. He was not a US person. She was helping her father, who was a very successful business person in New York. He established a contracting business that was very successful, but he only had a second grade education and he did not read or write English very well. So she was helping him with a lot of the financial kind of issues. And they had established accounts at UBS in the 1990s. A lot of that was for privacy reasons because they lived in Greece. They originally had the accounts at local banks in Greece, but they found that the employees of the banks were talking about who had money and so forth. So they were very concerned with privacy issues. So that was why they had these banks in Switzerland. The IRS, when they started to audit this woman, Miss Marika, made certain assertions that if you parse through the facts, they said, she didn't tell UBS that she was a US person. And she is countered with, I gave them my US passport, I gave them my Greek passport, which said I was born in New York. So there's a lot of discrepancy going back and forth with the facts. But if you parse through them in the various cases now that have come down, and the latest one in Kathalos was just decided also in the summer, you're going to see that this woman did not have any clear indicia of willful tax non-compliance. She had a lot of very good facts on her side. The family accountant was used who had no idea about FBARs. They used him from day one, forever and ever. He was probably their guy from the business days in New York for the father. And he was just not an international tax professional. So they were never properly advised. And they, as families typically do, especially European families, traditional families, certain funds were commingled. And it became, almost like a family affair. But poor Marika Kathalos has been just embroiled in this entire mess. And so much of it, I believe, the IRS is being so harsh with that case is because the bank accounts were involving UBS bank accounts, and the year that the IRS is charging her for willful tax noncompliance for her F-bar failures is 2007. 2007 was a big year. If you look at some of the cases developed in the F-bar proceedings, you'll see that 2007, they're always picking that year. Why is that a year that is always highlighted? I believe it is because UBS, that was the year that Bradley Birkenfeld blew the whistle on UBS and said UBS has been aiding Americans to hide money overseas and not pay taxes. So I think 2007 is a big red highlight for the IRS, as well as having bank accounts at UBS or probably any Swiss bank, but UBS being a real spotlight for them. In any event, I think the bottom line is people now going into Streamlined have to be extra careful. I have given my view on how Streamlined statement of fact should be looked at these days. I think that they have to be extremely detailed. You have to make sure you are covering all of the aspects the IRS lists in its FAQ for entering Streamlined. When you're preparing the statement of fact, they tell you what kinds of things they want to see in there. Go through, though, the FAQ and make sure you're hitting all of those points. The agency is scrutinizing these facts more carefully, and I think it's in part because less people are using the Streamlined procedures. Most people have already used them and become tax compliant, and there's greater public knowledge. Now it becomes more difficult for people to argue they didn't know about F-bar, they never heard of FATCA, they didn't know how to report overseas assets. These arguments are not being well received at all. So the IRS can always counter with this reckless disregard or willful blindness argument that the information's out there. If you've turned your back to not read it and not want to learn about it, that is not going to be accepted as a non-willfulness. When I approach Streamlines, okay, I talk very carefully about whether the person has relied on a tax professional before, what they were told, get that tax professional's name, see if you can speak to them to verify what your client has said. Did they reveal, for example, they had overseas accounts to the tax professional, and maybe the professional just didn't know about F-bar. So one of the points in the FAQ, the IRS wants to know if you've relied on a professional advisor, and they want their name, address, and phone number, and a summary of the advice. So it clues you in that the IRS may be double checking these facts. And we try and set the stage for why the taxpayer had reasonable cause for the failures. So why his reliance on the tax professional might be justified. So preparing a statement with extra care to these kinds of points will probably help, because if you fail on non-willful, you may try and be able to argue you've had reasonable cause. And there's a lot of different guidance out there to help you in determining how to set the stage for reasonable cause. There's a very excellent case when people say they've relied on professionals. It's called Neontology. That is the case that gives you, Neontology Associates, gives you a 3-pronged test that taxpayers have to meet to show reasonable cause reliance on a tax professional. So if you can get that into your statement of fact for your client, it will be very helpful. When you're dealing with clients that want to go into Streamlined, you have to make sure they really understand now that it will be most likely looked at under a microscope a little bit more than before, and they have to be very careful. Don't, as a tax professional, just take your client's word for everything. You really have the duty to do a little more due diligence now and spot check and see if what they're telling you is backed up by the facts. So if you're concerned and you feel you need help on preparing a statement of fact for your client, we can certainly assist you if your client is willing to engage us to help. So just let us know and pay attention to my blog postings. I'm doing an awful lot of recent blog postings on the streamlined procedures, the risks involved, and what the latest and greatest cases are. So I hope that this little insight has given you some valuable information and will help you take forward your client's case in a good way.